It's time for us to mark the final session of this week. This is a plenary session titled 2020 in the Rearview Mirror. It'll be a conversation about the future of financial inclusion.
Hi everyone. Hi Claudio.
It's a sunny day here in Columbus, Ohio, where I was a professor. I am also in the board of trustees of the BBVA Microfinance Foundation, but I will be speaking my own views and none of my institutions that I belong to. So how is it in Cambodia?
Very well, thank you. It's evening already here, and I'm very honored to have the opportunity to discuss with you for this upcoming 45 minutes. So looking forward to hearing your first thoughts to kick off this conversation.
It will be a pleasure. We are expected to talk about the post-pandemic future. And one thing that we know about the future is that we don't know what it will look like. Most likely, it will not be a return to the old normal. The world is too dynamic a place for that. And we don't know what this new normal may look like. So it's a world of uncertainty. And this uncertainty would have been here even without the pandemic. The fourth industrial revolution brings accelerating change. And there are also some major demographic transitions going on. Societies are aging. Pension plans are collapsing. All over the world, the old patterns of behavior are changing. The ways we work, the ways we produce, the ways we consume, the ways we save, the ways we age, the ways we communicate, the relationships that we engage in. So it is almost impossible to forecast the future, and later on I will tell you some consequences of that. But there are two facts of life that are an inevitable dimension of the future landscape. One of these is a generalized impoverishment. The world is poorer, the world will be poorer for some time because of the pandemic. The incidence of poverty will increase, the depth of poverty will also increase, the poor will be getting poorer, the volatility of incomes will augment, it will be easier to fall into poverty traps. We know some of the numbers. This year, the pandemic will push up to 115 million people in extreme poverty. Conflict will displace 80 million people. During the next 3 years, climate change will drive between 70 and 140 million people into poverty. But these are just the extremes. But what is true is that we all are poorer now, if only because life expectancies have declined. The numbers of unemployed increasing, the length of unemployment increasing, informality increasing, an informal sector that has been very vulnerable to the pandemic. Digitalization that may shorten or increase gender gaps, may increase or decrease inequality. But ironically, poverty, exclusion, informality will create opportunities for microfinance. The microfinance market will become more complex. It will have to include not only those previously excluded, the poorest of the poor, but also earlier clients that had escaped poverty and that have fallen back into poverty, but that still they possess some of the assets, human capital, business experience that have made them successful before the pandemic. And there are the ones that have demonstrated their resilience and will have opportunities to grow. So the microfinance institutions will have new opportunities for innovation, for client segmentation, for introducing new products. And their role will be to equip their clients in facing these new challenges. And in doing this, microfinance institutions possess a strong comparative advantages derived from the intimate knowledge that they have person to person of their clients. So I expect the role of microfinance will be rediscovered. And after refreshing, that the role of microfinance will be reappreciated in new light. The claims of a no significant impact of microfinance will be eroded, will shrink, that we will understand better why finance matters, and that it matters precisely in times of change. That each type of financial service, credit, deposit facilities, payments, insurance, all of them matter, each one for a different reason, each one in playing a different role. And in the transition to this new post-pandemic future, they will all matter a lot. Of course, microfinance will not be the solution, but it will be a key component of the solution. And then, ironically, the pandemic will make microfinance more important. Impoverishment is one of those two facts of life I wanted to highlight. Increased systemic risk is the other one. The pandemic is a systemic shock. No one has escaped it. No one has escaped its consequences. Climate change is a systemic threat. Conflict, civil unrest are systemic shocks. And this systemic threat, this systemic risk threatens both clients and the institutions at the same time, for the same reasons, from the same sources. Microcredit may not necessarily be the best tool to prepare and cope with systemic shocks. And if the shocks are systemic, group credit typically collapses. And local microfinance institutions will not survive many of these systemic shocks. And during these times, two types of efforts are needed. The clients, they need access to a broader range of financial services, deposit facilities where they can accumulate savings as a precautionary reserve, payments instruments to send and receive remittances. They need to have access to payment systems for the government-to-person emergency transfers. Various types of insurance will be extremely important. And the microfinance institutions will need access to liquidity. They need to hold larger reserves. They will need to see how they can meet higher provisioning requirements. They will need portfolio insurance, particularly index insurance in addressing catastrophic events, access to lenders of last resort. Perhaps this may be a role for impact investors, access to guarantee funds. And what does society need? Society needs more robust institutions. Institutions with a much broader scope of operations, definitely deposit-taking institutions. Institutions with a spatial and sectoral presence, national institutions, not municipal institutions, that have much greater opportunities for diversification. And if the key dimension of the future is going to be uncertainty, we need institutions with a strong ability to learn. We need institutions capable of forecasting and adjusting to changing scenarios, so that the most valuable feature of microfinance institutions in the future will be the quality of their knowledge management efforts. What do you think, Dina?
It's a lot already that you're sharing with us, Claudio, and a lot of things that I agree with. I guess maybe to complement on what you said, I'd like to maybe, as you mentioned, focus a little bit from an impact investor perspective, and first looking at what has happened to us since COVID-19 has hit, and what do we foresee, the future in front of us? I think, first of all, I'd like to say that, there was quite a remarkable reaction of the overall impact investor community when the COVID-19 hit, and when we started to really see bad impact at the level of our microfinance institutions. And what I'm talking about is the level of spontaneous coordination that all investors showed by, really understanding that we had to be in it together, that there was really no possibility for somebody to play the free rider. And I think I really appreciated, the level of like-mindedness that was put into, looking into restructuring loans together, into looking at rolling loans, rolling over loans, taking risks together, into looking at handshake agreements. I think, for an industry that is often criticized now, I think, as you said, there is potentially here an opportunity for reappreciating the true essence and the actual, walking the talk proof that many investors have shown over the past month. So I think this was, kind of the first thing I wanted to pause on. Having said that, I think in front of us, from an investor perspective, there's a lot of challenges. Yes, we have restructured those loans, and we have done so that our MFIs could themselves restructured. But the truth is, among this high portion of portfolio that have been restructured, we know that some of them will have to be restructured again. We know that some will fall into portfolio at risk, and we know that some will have to be written off. And within that context, I think, again, we need to show agility. We need to be able to engage with our investment committee and risk committee today to educate them on the fact that those, very nice financial performance metrics and really nice covenant that we used to ask them to our MFIs to comply with, it will not be the case, and that we need to show, major flexibility in order to back the institution, as you said, that are meaningful, the ones that are able to survive in that environment, to continue putting in place the right systems to serve their clients well. So I think there is a huge existential challenge in front of us from first of all a lender's perspective, to be able to provide the liquidity necessary for this really hard times still ahead of us, and for being able to not destabilize institutions that are still coping with the crisis. I think that's one key point. The second one is related to your point on increasing poverty. I think, each time I, look at the news, or even in my daily life here in Cambodia, I think it's, it's unavoidable. We have to come to the conclusion that maybe we've gone backward for quite a few years on some of the work that we had tried to accomplish as not only microfinance, of course, but the entire impact industry and beyond, in trying to contribute to sustainable economic development. So here again, it's clear the end clients are poorer. In Cambodia, for instance, again, many households, what do they rely on in terms of income? They rely on agriculture, yes, and it has shown that it's actually been one of the most resilient sector in this COVID-19 situation. But they rely also on sectors that are highly exposed to international trade. And when the borders are closed, tourism is closed, and the waitress of the restaurants or the taxi driver, they don't have any tourists to walk around, and therefore they don't make income, and therefore they can't service their loan. That's just a clear fact. The second key pillar also in Cambodia, which I think is also a major pillar in a lot of other South Asia countries, garments. And here, Europe is in lockdown. Everybody is going to be more careful around how much money they're going to spend for Christmas, gifts. Well, there are not going to be that many, consumption of buying, clothes and everything for Christmas. So the garment factory are simply closed, and the people are simply at home with no income. So I think, yes, we've prevented a huge shock, but I think we should not underestimate how much resilience we need to continue show because again, a lot of people simply don't have income anymore. Yes, the economies in emerging markets are likely more agile than in developed countries. So there is a hope that people can, just starts shifting to other type of sectors, but this will still take time. And I think we here have a huge responsibility in front of us to be able to accompany these institutions. So I think in that context, just to add the third point, and then maybe leave you the floor again, I think, whether we are lenders or whether we are investors, shareholders sitting at the board of directors of company, we have a responsibility to guide our institutions and not to overburden them with reporting and explaining. And I think we need to let our microfinance management teams run the show, be able to concentrate not only on asset and liability management committees, but also on making business decisions in order to make their business survive. And one key trend that, of course, I'm sure you've seen also in your part of the world is that all these, buzzwords about digitalization, now it's pretty much, such an acceleration of the conversation that, I often hear digitalize or die, basically. And I think here I see it as a huge opportunity on one hand. If institutions had starting digital strategies, they are likely in the good winning batch to be able to make it, to be able to change their process today, to make digital solutions still at the service of customer centricity. So not to fully replace the human touch, right? But to be able to accompany in that new environment where we can't meet as often, to accompany still the delivery of services. But there's also a huge risk, when people are stressed and their loan is restructured, and in the meantime you tell them, oh, by the way, and this conversation on restructuring of your loans is not going to happen through a loan officer's visit, it's going to happen through, an email or a text message sent to you. And then before you know it, the restructuring fees, it's not clear, and people don't know how long they restructured their loan for. And so I think there's a huge client protection principle thing at stake here that we all should be very, very mindful of. And again, sharing it from an investor perspective, this is our role to make sure that, yes, we want to be agile. Yes, we're going to be highly focused on credit risk assessment, but social performance, client protection principles, assessments, HR risks as well. There will be some entrenchment, that furlough. We need to be highly vigilant on helping, maintain high standards, understand the reality of our MFIs, of course, but also make sure that we don't shortcut on certain basic principles and practices that we have been defending for so long. So, this is kind of a reaction to some of the other issues that you raised. And I think they're hopefully quite aligned as well in our two regions. I think we're facing a different situation, but also quite similar. So
yes, indeed. And perhaps we can build up a little bit on these earlier remarks. If systemic risk is going to be central, the kinds of institutions that we will need are institutions that can examine information, foresee trends, institutions that possess a keen analytical and strategic skills. Also, in a sense, institutions with deep pockets that will be able to withstand hurricanes and tsunamis, and with deep pockets, but own or somehow supported by patient investors. And I think that during this transition to the future, patience will be very important. Institutions that are concerned for sure about their sustainability, but are willing to postpone profits, are willing to postpone excessive gains. And all of this implies the emergence of a new market structure, possibly a market structure with fewer, larger, stronger microfinance institutions capable of offering a broad range of services, financial and non-financial. And the success of this process of market consolidation is going to depend on the regulatory framework in place. And because typically regulation lags behind the market developments, this is very critical. Many microfinance institutions may not survive the pandemic.
mm-hmm.
And it is important for investors and regulators to allow these weaker players to leave the market. Systemic shocks like the pandemic bring out weaknesses that were there hidden by otherwise growth. Weaknesses in institutions, procedures, products, and impact investors, regulatory authorities must let the market adjust and allow them to leave. But at the same time, the authorities have to create an environment where innovations are promoted, where innovation goes hand in hand with stability. The ideal scenario for all of this to develop will be a constant interaction between the regulators and the market participants. Unfortunately, in recent times in Latin America and possibly in your part of the world as well, the authorities have shown a preference for a repressive regulation. Rather than facilitating and promoting regulation. The instruments of financial repression are back in many Latin American countries. Interest rates, caps and ceilings, mandated portfolio quotas, taxes on financial transactions, the political capture of financial institutions, and the pandemic and the recession that has come as a consequence of the way we are fighting the pandemic has given all kinds of excuses for the adoption of appropriate interventions. The arguments abound about these incorrect policies that will be introduced as temporary emergency measures. It doesn't matter if they will be distorting, but we know that they become permanent. And this in the case in Bolivia, for example, which had one of the best microfinance sectors in the world, and where the introduction of interest rate ceilings and other repressive measures has reduced the number of clients reached, and who are the ones that are not being served anymore? The poorest, the youngest, the one who live in the rural areas. The same thing has happened in Ecuador, where similar regulations were introduced. Costa Rica, some of the finance companies, when the regulations were introduced, let go hundreds of thousands of clients and employees as well. In general, what we are seeing is that efforts to correct for market failure are being countered by the introduction of government failure and rent seeking in this market. But at the same time, authorities are lagging in adopting critical norms to organize the market. In the fintech area, for example, in the competition between fintech and banks, they are lagging in the authorization of new types of services, particularly related to digital transactions. And even more, the state is missing in action in the development of the physical and institutional infrastructure that is needed for the markets to operate more efficiently. And in the absence of this infrastructure, transaction costs are prohibitively high. Credit rationing excludes large segments of the population. I remember when I was teaching at Ohio State that the students asked me, tell us one thing that the government can do to improve financial inclusion. And I always told them, build roads. What do you think?
Yeah, I think at least in this part of the world, in certain countries, the microfinance sector has become a huge economic sector. So it is, of course, subject to more scrutiny from the government. Before, if you had a very small outreach, nobody really cared about what these microfinance institutions were doing, right? Today, of course, if you realize that half of your citizens directly or indirectly are linked to microfinance through loans or savings, so then the minute that you start to have potentially as a government a populist agenda, then it starts to be an interesting tool to use to increase your popularity. So I think that unfortunately the trend that you're describing is also likely very applicable to this part of the world. Now, having said that, I also don't want to be over negative about things. I think that yes, we have unfortunate regulations which suddenly decided to cap interest rates. Yes, we have certain markets where it's very hard to channel international funding, while there is actually no local commercial banks even understanding the credit risk profile of the microfinance institutions. So the situation, of course, is there. Having said that, I also see that for me, the way to tackle this issue and the few initiatives that I've seen working is when they are a group of sizable, regulated, like-minded microfinance institutions who take the fight and go talk to not the government representative, but their regulators, the ones that are likely to be more civil servants, with having a little bit more of a neutral agenda, and try to feed them just with data and proof and examples. And I think we had conversations in certain Southeast Asia markets showing to regulators that as you said, interest rate cap, look, it just leads to increase of loan size and decrease of outreach. So if that's what you want to do, then you want to pursue doing that, right? Did it change fully the mind of the regulators? Maybe not, but did it, start equipping the most like-minded civil servants in some of these Ministry of Finance or central banks with the right argumentation to go and lobby their government? I think so. There's also a number of initiatives just on self-regulatory measures, where in the Cambodian market, for instance, institutions just started, being in very mature environment where growth is just, a story of the past. And then they started saying, well, how come that we continue growing so fast? And then we realized that it was a lot of refinancing. And in order to kind of, slow down this like aggressive poaching of clients and refinancing, a very sizable number of microfinance institutions sat around the table through their association and decided for themselves to abide with a number of key risk principles that were not even, imposed by their regulators. So I think for me, playing that role as investors to tell these MFIs, we want to support you, let's go and talk to your regulators, let me lobby along with you, let me bring the development financial institutions who have behind them embassies and diplomatic representations. I think it's still a very powerful channel to continue trying to contain the risk of populism and political contamination to the market.
That's very nice. Yes, I like your optimism, and hopefully we will be able to engage in those kinds of conversations with the authorities and show them facts. I think that in these days where there is so much truth and so much fake truth, that the conversation becomes even more difficult. But there are many lessons from history. And I think that this is not the first time that these interest rate ceilings are introduced, have been introduced and then dismantled 4 or 5 times during my professional career. And the central lesson perhaps is that we have to learn from history and help these younger generations to learn a little bit from history. But just
remember
in direction, we have talked about these changes in the aggregate context, poverty and systemic risk, and the need for finding opportunities for adjustment. But I think that in the post-pandemic world, there will also be a revision of the mission of microfinance institutions, not an effort to abandon their core purpose, but to explicitly add other goals, to explicitly recognize other concerns. And I am thinking in particular about 2 major cross-cutting concerns that will be made more explicit. One of them, gender, has already been there as a main mission component in some particular microfinance institutions, as an afterthought in some other cases. The protection of the environment has not been explicit until more recently. But I think as we move from this crisis situation, that these two dimensions, gender and the environment, will be universally adopted and will become dimensions of mainstream definitions of missions for microfinance institutions. And they will be important at both ends of the transaction, at the level of the client, at the level of the institution. This is the case of what we have been doing at the BBVA Microfinance Foundation. We have been addressing the pandemic with three major concerns in mind: the protection of the staff, the protection of the health of the staff in our headquarters in Madrid, but also in the 6 institutions in the field. The support of our clients, because we recognize that we have engaged in long-term relationships with them, and that the reciprocity implicit in these relationships requires us to assist them, to put them before any other potential business opportunities that we may have, and to assure sustainability of the institutions. Gender is very central in trying to implement this perspective. And in acknowledging the importance of reducing gender gaps, we have done several things. We have been very interested in the diversity of our strategic and management levels. The very board of trustees, where I am a part of, out of 8 trustees, 5 are women. And in the boards of the microfinance institutions in the group, as well as in the general management positions, there are some extraordinary women. It's Margarita Correa in Banca Mía. It's Elizabeth Ventura in Financiera Confianza. It's the two Canalda, Doctora Canalda and Meki Canalda, Doctora Canalda and Meki Canalda in ADOPEM, which sort of shows something. One, our tremendous appreciation of what women managers and directors can contribute, but also our desire to leave is the institutions that we have acquired, the experience, the local knowledge that has been there before these institutions were acquired. And all of this permeates down the organization across the staff. And at the other end of the transaction, we are very interested in designing women-friendly channels, women-friendly products, products adapted to the women's life cycle, products that emphasize their health, savings, insurance, to adopt screening methods based on segmentation by women and men in order to offer a value proposition to them that fits more their particular interest. In thinking about digitalization, it is very important to try to reduce the gender gap that might prevent access to digital products by women. We are certainly measuring all of our outcomes and our social performance, including tremendous decisions by gender. And financial education is a central piece of all of this. We have a program in Peru, along with Care International, Conectate, which is trying to help women to improve their digital capabilities. And in Colombia, EmproPaz, which is a a program that Banca Mia has developed to reach displaced populations and refugees, Venezuelan migrants coming through Colombia. There is a tremendous emphasis on gender as well, and this has been supported in a collaboration with USAID. Chile Fondo Esperanza, of course, has a long history of concerns about gender and has this entrepreneurship school, which is very, very appreciated. Let me share with you just a second something which might be somewhat interesting. I have been recently writing a chapter for a handbook of financial inclusion, and I have been writing about how the foundation measures outcomes, the outcomes of our activities. And one of the questions that I have asked is, what is the marginal productivity? What is the marginal impact of different loan sizes? And the question is, if I have one additional euro of loan size, of increasing loan size, if I give this one extra euro to a woman client, what happens to household income? What happens to household per capita income? If instead I gave that extra euro to a man, what happens to the household extra income? And it turns out that the marginal impact of increase in loan size is much greater when the loan is given to women than when the loan is given to men. In fact, one extra 100 euros given to a woman increases household income by 520 euros a year. That's about 1.3 euros per day. If you give it to a man, instead of 520, the increase is only 380. So this is an interesting way of thinking. There is something that women are probably more credit constrained because of all of these circumstances that limit their access to markets, that there are interesting opportunities that women have that are not being exploited because they don't have access to financial tools. And then when we give them, they can take greater advantage of this. Of course, all of these marginal impacts are diminishing. So at some point, the diminishing marginal returns to giving loans to women has declined so much that you have to start adding men. And in the end, you try to develop a balanced portfolio in terms of gender. But if the marginal impact on women is greater, I would expect to have more than 50% of my clients being women. And in fact, 60% of our clients are women. So that's what we are trying to do. And that's a little bit of my more academic mind sharing it with you.
Very insightful, Claudio. Thank you. And I'm also trying to keep an eye on the chat box, and my first comment on the chat box was that there are a lot of people making comments and insights, so that gives the European Microfinance platform a lot of ideas of other panelists for next year's debate. But there's an interesting question, I think, that links to what you were saying about gender. So on the gender, first of all, I need to congratulate you and the BBVA Foundation for the work. I think what you're doing is still niche. Tracking outcome, focusing on gender strategies. Yes, a lot of us are trying to do this, but the magnitude and the depth that on which you're applying this strategy is quite remarkable. So I think we need to acknowledge this. I would say indeed that, well, gender is, all the more high on the agenda for the upcoming years. As we know, I think there was many reports saying that, okay, a lot of people went back to poverty, but when you look and you split it between male and female, I think it's quite clear that female were even hit in the worst manner. And I think it was because in most cases they are part of the informal sector. B, it's because they would typically be working in hospitality or services. So these are the two sectors that were the most hit. And C, when they lose their income, formal or informal, then they go home. And in many societies with specific culture, then they are being asked to continue taking care of pretty much everything, right? Cooking, cleaning, taking care of the kids. So the burden, and again, this idea of going back to to the past is really quite unbearable from when you think about it. So I think my call here is to say that yes, we should not think that everybody has lost its income the same way, and that our current financial products from our microfinance institutions are necessarily suited for the sake of helping people get back on their feet. And I think what you were saying about looking at products that would have a gender lens in the way that they're designed to take into account the reality of female daily life and economic opportunities or lack of opportunities is key. I also think that maybe we're going to have to start taking more risk and develop products where we are helping people start up new business and not expect from them that they have an existing business, because maybe that business is gone because that sectoral activity simply will not exist anymore. So I think that's another key thing that we need to recognize. It might not come thanks to just us providing loan and providing equity. I think there's a huge conversation again on how we help our institutions develop maybe non-financial services support. I take the case, for instance, of the agricultural sector here in Southeast Asia, with still a lot of smallholder farmer exposed to a lot of climate risk, completely excluded from market access. Yeah, we can finance them the right amount of money at the right time when they need to plant. But the truth is, their yield goes down, their agricultural techniques don't work anymore, they're subject to climate risk. So providing financial services doesn't work alone in itself. Is there a way for, as you said, the most sizable, efficient institutions to be able to be more socially innovative and not only see their social mission as financial service providers, but indeed beyond that, being able to provide also the technical means, maybe for people to, I don't know, well, from there's quite a few interesting initiatives here on, agricultural information app, where you understand what is the market, what price you can sell your crops, to whom, what do you need to watch out for because it's going to be raining more than expected, etc., etc. So I think there's a huge field out there, which is, again, for me, an even stronger reason to continue thinking that it makes sense to continue being involved in the microfinance institutions. I know there's often a lot of conversations from donors saying, microfinance is too mature, let's let it, let's go invest in other sectors. No, I think we still have a lot of things that we need to figure out. And finally, on the gender thing, I think, as you said, it has to be ingrained in the strategy, in the company itself. And for me, we need to move away from being satisfied that the total gender ratios and the number of total staff is okay. And then, as you said, not look enough in actually what is the balance and what is the gender ratio at top management position and at board level position. Because now the argument of saying, oh no, but there were not enough women, they don't have yet the experience, this argument is flawed. There's a lot of head of department, there's a lot of middle managers, very competent women that, if being given the opportunity, if again taking into account that yes, they still need maybe to go pick up their kids because they're in the traditional societies where it's going to take a few more years for their husband to consider go pick up the kids, if we allow that type of flexibility, they will thrive and they will be as competent and as the leaders as any other person for that matter. And I think I appreciate your call and your appreciation for all these ladies that I don't know but that you mentioned. It's quite an inspiring message.
Well, I have only to listen to you to know how valuable to have this diversity around is for all of us. There are two things that you said that are probably two of the questions that I cannot resolve in my mind yet, and that are very challenging. One is if microfinance should be engaged in financing new businesses. The question is credit the appropriate tool to deal with someone that is starting a business? And I don't think credit is the right tool for someone that doesn't have any experience or where we don't know what to expect from that productive opportunity. But that doesn't mean that that productive opportunity is not valuable or relevant. It's just that more financial innovation is needed to make it possible to support the emergence of these new businesses without sort of burdening the new entrepreneur with debt that they may not be able to pay, and that will then make them even poorer than they were in the beginning. And I am glad that you were talking about the role of non-financial services, because this is an example of how people can change. And if you would have listened to me 20 or 30 years ago, I was a very active defender of a minimalist approach to microfinance, financial services only. And one of the lessons that I have learned in recent times is that the complementarity between financial and non-financial services is critical for the management of risk, for the improvement of the client, for our ability to have a true impact in the life of these people and not just continue financing their subsistence. And how to put these two things together is one of the challenges of management in microfinance organizations. And in some cases, and I am very much in favor of that, the combination of financial and non-financial services will come through various types of alliances with the local technical assistance unit from the government, or with the local veterinarian, and so on and so forth. And this leads me then to think a little bit about this other cross-cutting concern that we were identifying, the issue of environmental sustainability. And again, in thinking about what is happening at the foundation, this has to be a total integral commitment. It's not something that you add as an afterthought, but it becomes a part of your own ADN. In the foundation, we talk about a green corporate culture that is an integral component of all of the operations of the institution. And then once you have done this, you can incorporate environmental risk in the analysis of credit portfolios. You can improve value offers for different clients. You can improve impact on the society at large. And as you said, climate change, very much in the same way as the pandemic, hurts disproportionately the most vulnerable populations, hurts disproportionately women. I think it is Davide Castellani who wrote a little message that I could just read with a little bit of my eye there, that are we learning something about dealing with systemic risk from the pandemic that will be useful in dealing with climate change as a systemic shock? And yes, of course, we need to develop instruments that are very scarce still about how to approach systemic shocks. At the foundation, we have adopted lists of activity exclusions that will be damaging to the environment following guidelines of the IFC. We pursue our own eco-efficiency. We are reducing our environmental impact, measuring our carbon footprint all the time in order to reduce our own impact. alliances here, for the reasons that we were saying, are extremely important. We have with FAO, ICA, United Nations, Habitat International, and so on. And this is one area where finance, technical assistance, training, access to markets are a package that, if it is compounded, if it is put together, creates important economies of scope. And we have training activities in agriculture, in sustainable agriculture in the various institutions. There is a demonstration farm in Colombia where we bring clients to look at mitigation and climate change adaptation. We create communities of knowledge digitally and so on. Here, once you have incorporated the commitment to environmental sustainability as one of the pillars of your corporate culture, then the other things follow. And I think that this will be a tremendous contribution that microfinance institutions can make.
I think you have found us a topic for a whole other 1 hour debate, Claudio.
Yes, I know.
I think our time is up, but just personally, I wanted to thank you for the opportunity of this conversation, and maybe to say that this year we couldn't meet physically, so our CO2 emission as a whole community has been much lesser. So maybe next year, if we have the pleasure to meet physically, we should all think maybe on how to net off our CO2 emission by flying in order to be aligned with what you've just described on the need for a stronger and more ambitious green strategies, which I very much agree with. But thanks again.
It has been a great pleasure. And I don't know if you want to, Dina, you want to look at one or two of the questions or the comments that the audience has done, or we have to go? I know I have to. I'm sorry.
Yeah, no, as I said, there was a lot of very insightful statements. So maybe, hopefully the moderators could help us collect them and put them as maybe part of a little public document in addition to the recording of this conversation, just to share other people's insights. But I think otherwise, I understand from our host that our time is up, and there's some concluding remarks. Yeah.
And I miss one. Let's see. Too bad.
Laura, I think the floor is yours.
Thank you, Dina. Thank you, Claudio, for all those fascinating and so insightful comments to finish off. Good evening, good afternoon, and good morning even to everybody who has attended the European Microfinance Week, our participants, our sponsors, and our many, many speakers. I'm delighted to be able to say a few words to close off European Microfinance Week 2020 on behalf of e-MFP and the e-MFP board. And, you know, this morning I was looking over my closing comments from last year thinking, well, most likely they will not apply at all this year because of our very different context and situation and our very new format. But actually, many of the adjectives I used last year apply as well. A fantastic conference, thought-provoking, energetic, and collegiate. And I might add, of course, a few new ones. Digital goes without saying, but also even more diverse and strong content and speakers, genuinely engaging, even more inclusive, actually, in many ways, and interactive, and despite, or perhaps because of the format, more personal in some ways. And I won't lie, I was a little worried about how this would all work out. It has been a trying year for many of us, for many of our institutions, on a personal and family level, health level, our business concerns, our concerns for our clients. And we've had a lot of virtual conferences. Would people still come? Would the tech gods collaborate? But then from those first visually stunning and very slick opening scenes from the Abbaye and the welcoming words by Christophe and our colleagues at the ministry, I thought, okay, we're off to a strong start. This is great. And then that very first note came in on the sidebar, and I think it was Laura Foos. So Laura, thank you. It popped up and I thought, yes, we're here. You're here. We're at home. We're out there. Welcome back. And we're all in this in a new way, but nevertheless all together. And it was such a special feeling. As our American colleagues would say, when you get lemons, make lemonade. And without wanting to make light of a global pandemic, I think at least in the context of European Microfinance Week 2020, we've made some pretty good lemonade. We've had over 500 participants from truly around the world. In fact, people who otherwise may not be able to join because they're not normally able to make the trip to Luxembourg to join us. We've had over 130 speakers from almost 100 organizations, and content that now will be digital and able to be accessed after the conference as well, and perhaps by even more people. So stay tuned for information from e-MFP on how to do that. Going online has been a huge logistical feat, new in many ways, but we also worked hard to maintain the things that makes the European Microfinance Week such a success every year. The quality of the speakers, the listening to you to make sure that the content is member-led and interactive and diverse. Thank you for your patience. At times, the occasional glitch, of course, did happen. It would not be fun otherwise. But thank you also for those of the teams who were able to support us as we came in with last-minute questions. And indeed, perhaps representative of what the industry is going through in many ways, we have adapted and in some ways come out much better, stronger. And so many of the innovations of this year's conference will be kept and applied next year, even if that conference is in person. Maybe it will be, hopefully. But we have lots of new formats that we've been able to test and that we will now be able to implement even more effectively next time. And a great example of this, in fact, is, of course, how we kicked off the conference with the honor and privilege of being able to welcome Ella Batt, the wonderful, impressive, humbling Ella Batt, and who, with her words of wisdom and a strong reminder, in fact, maybe even a stern reminder, to make sure that we kept the fundamentals of our industry at the core of what we're doing, people and planet. And that's COVID or no COVID were some of her strong instructions. COVID, of course, everywhere, could not be ignored. Some sessions specifically about COVID, others not so much, and yet it still popped up. And of course, it comes up in every topic, and all of these topics remain key to our industry, COVID or not. Digitalization, savings, women, displaced people, impact. If anything, COVID has served to re-emphasize the importance of doing all of these things well and the importance of institutional strength. We've seen Tier 1 institutions so far seem to have done well, and perhaps not so surprisingly, Tier 2 and 3 not as well. But one of the consensus that there is, and that one of our first plenaries reminded us of, so far we were relieved to see that the fear of a rampaging liquidity crisis in the industry would destroy the industry or set us back. That has not yet been the case, but a reminder that we are not out of the woods yet. We still have a long ways to go. And so to really stay on our toes. And we also don't fully yet understand the impact on our clients. A lot of work and research, interesting research is being done, but the need to look at data at every level, MFI, industry, beyond, has been reiterated again this year. There's also much effort to see how we can overcome the restrictions on how to do a lot of the research that's necessary in the industry and how to support organizations when travel is not possible, whether across borders or within country. And some of these topics have been addressed in the special edition of the Financial Inclusion Compass that e-MFP put out earlier this summer, specifically focused on COVID-19, which I recommend you take a look at. In the midst of it all, at this conference also and throughout the year, e-MFP was able to do some of the things it does best, not only the Compass survey, but also publishing other key industry resources, such as the long-awaited book, actually not even just a publication, a book, Taking Shelter, Housing Finance for the Poor. I hope you were able to join this session. I recommend purchasing the book. You can get it on Amazon, or speak, of course, to the e-MFP team. They'll be able to point you in the right direction. And we've had some considerable content from some of our leading lights on the topic in the industry who have contributed to that publication. A theme that has resonated throughout the conference, whether COVID or not, has been, of course, the importance and the desire for collaboration. We've seen in the response to COVID, fortunately, a very good collaboration, actually, from investors to regulators to individual financial institutions, but much more is needed across all topics. So one of the things that I'm sure we will continue to see. The other topic, digitalization. The numbers of people in the digitalization sessions, as well as how often it came out in and of itself throughout other sessions, have made it clear that that really is key. But I was heartened to see it's no longer a question of are fintechs going to eat my lunch? Are they good or bad? But rather, okay, how are we using digitalization? Where are the opportunities? And especially in the COVID context, a very real life test case of where it works, where having it would have helped, and where it does not work yet, or simply won't work. COVID, of course, has re-emphasized the particular importance of savings, that humble product that sometimes sits in the background, and was the topic of our European Microfinance Award, with many sessions and high attendance on everything from best practices to case studies to regulation, usage metrics, you name it, and some incredible speakers on that topic as well. We encourage you to take a look at the publication on that the e-MFP has produced on the topic, which is called Encouraging Effective and Inclusive Savings. And of course, that publication highlights the work of the finalists of the European Microfinance Award of 2020, which we were delighted received a great response rate despite everything that's going on. We had a moment where we wondered, is this the right thing to do this year? Do people have time? But does it seem insensitive to push ahead with that topic? And if anything, it has proven the right decision. And we're delighted and congratulate this year's winner, Muktinath Vikas Bank in Nepal, for the excellent work that they are doing in savings. So we look forward to hearing more from them at next year's award. So to finish up, I'd like to thank several people. The sponsors, of course, please take a look at the exhibitor section on the portal. Normally they appear behind me at this point in time. Our communications partners, our many guest speakers and moderators. Thank you to those who got up very early or very late. We've seen the sunrise in some contexts, the sunset in other contexts, in order to lead fantastic sessions throughout. Thank you to you all for coming. Again, making the time in your busy lives. But above all, I would like to thank the e-MFP team, Charles Mace and his Good Vibes team. I had recommended to Christoph Pausch as we started this process, I said, keep it simple. Don't overdo it. Everybody understands this is very complex. This is going to be really hard. We don't need to have as many sessions as usual. And luckily, he completely disregarded my comments. And everyone has been able to benefit from a much more rich experience than would otherwise have been the case if he had listened to me. But it was, of course, a huge task. We asked Charles Mays and the Good Vibes team to put together a conference that's even more complex than when it's an in-person conference, which is already a very challenging thing at the ABI every year. And it was in a compressed timeline. It's because we only knew last summer that we were going to do this format. And so there was so much to do. And both he and his tech hosts, his translators, the support staff, everybody who has contributed throughout in addition to our fabulous e-MFP team, it has been very, very impressive. To give you an idea, over 25 people in Belgium, in Luxembourg, in Portugal have been working around the clock, morning, noon, and night, on all sorts of fronts and many different windows and many different screens over the last days, weeks, and months in order to make this such a successful event this week. And so on that note, we look forward to welcoming you to next year's European Microfinance Week, perhaps in person, perhaps virtual, in any case, retaining all the best of this year's format. And not just because of COVID, the focus next year will be on health, the topic of next year's Microfinance Award. And so lots of interesting content that will be coming from that, and new actors and new players to explore. And so as we usually move towards the drinks session after my closing comments, I raise my glass to you all. I wish you all the very best, to you, your families. We wish you good health, and we look forward to seeing you again next year.
Thank you, Laura. It is time to mark the end of the European Microfinance Week. Thank you to all of you for having been with us, for having participated. Without you, this could not have happened. If you want to continue networking, the platform is still available. As we said before, all the recordings will be available for you to check out if there's anything that you've missed. It's been my privilege to be your guide for this week. We look forward to seeing you next year. Thank you.